Well, I know it's been a few moments since I posted my last video. Actually, it's been over 10 days, and I do miss you guys a lot. Hopefully you guys miss me as well. A lot of things we're going to talk about today, portfolio construction being number one, but I'm also going to talk about a few different stocks that I think are fairly safe at these levels, and you can look for some serious upside. So let's get into it. Before we get into a few stocks that I'm actually looking at purchasing, I actually want to talk about a position that I just sold out of, ticker symbol GOLD. This is Barrick Gold Corporation. This is a gold miner. And the reason why I even thought about buying this is notice that the correlation between gold miners and the price of gold going up was a lagging effect, meaning that the gold miners looked like they had a tremendous amount of movement, still correlated with that gold price, but just wasn't happening. So what did I do? I bought into what I thought was an interesting catch-up trade here in GOLD, the gold miner, to catch up to the price of actual physical gold itself. And that definitely was a nice move as we had a pretty substantial pop here of over 20%. Bought in right around $15, sold out at $18, which overall was a few $100 gain and actually got us over the $30,000 mark in our portfolio, currently sitting at $31,383. And we are over 41% in T-bills right now. And the reason being is that we're getting 5% risk-free for the most part, sitting in a T-bill. We took some of those gains from gold and building a fairly defensive portfolio here. And I want to talk about some of the names that are up here. We did add into Pfizer, which is now our largest position, sitting at 11%. I'm going to add more cash to this. So this position will get diluted down to probably closer to 8 to 9%. And CVS is another position we added into today, around $69.90 a share. If this got into the low 60s, high 50s, we would most likely double our position by adding more capital into the portfolio and keeping it right around 8% weighted. We also added into Smuckers, ticker symbol SJM. Now, these are three positions that I think are pretty interesting overall when I look at a risk versus reward type of basis here. And I look at an earnings picture that I think can deteriorate towards the end of the year. But I think a company like CVS can earn $2 a quarter, basically $8 annually. And when we look at trading it trading under $70 a share, you're looking at a single-digit PE ratio. For a company that I think has pretty substantial earnings and doesn't have a tremendous amount of downside risk at these levels. Do I think it could get into the high 50s? Possibly, but even at those levels, I'm ready to average in a little bit more with CVS. And then we look at a company like Smuckers, ticker symbol SJM. When we think about the consumer slowing down, possibly going more to at-home type preparation when it comes down to meals, eating, and coffee consumption, well, that fits all into Smuckers' wheelhouse, and this is basically trading at a multi-year low, and earnings has been a big problem with this company, which I touched on the live stream last night. I think Pfizer has the capabilities of earning right around $2 a share, annualized out, which means that it's basically trading at 11 to 12 times forward earnings, in my opinion. I think this is a company that's quite capable of doing that and actually quite capable of surprising to the upside with earnings, which means that it could be tremendously undervalued depending on what's coming through the pipeline. We think about the recent acquisitions that Pfizer has done with the acquisition of Seagen. You're basically buying Pfizer and getting whatever comes from Seagen almost free at these levels. And so my biggest concern with Pfizer is, are they going to be able to maintain that hefty dividend? And that's going to be a big issue, I think, for Pfizer going forward if earnings do start to deteriorate. So there is some risk with all these positions, but I tend to think that the risk versus reward favors to the upside in all three of these positions, especially if you can get Smuckers under $110 a share. Anywhere between $90 to $100, I think, is very, very interesting for Smuckers. Now, the thing I want to point out is the fact that I do have 41% of my portfolio sitting in T-bills, but yet I'm still keeping up with the Dow Jones and slightly underperforming, and definitely underperforming the S&P 500. But when we think about the downside risk that can come in my portfolio, I definitely think there's a lot of insulation here with the amount of cash that I have on the sidelines here to buy the dip and or to earn 5% yield. So that gives me the flexibility to lower my downside risk and take on a little bit more of what I think are deep value type positions here. And that's kind of the goal of what I'm trying to do here. I'm trying to capture as much upside with as little downside risk as possible. And that's why I'm structuring my portfolio in such a manner. So please do not take this as financial advice. This is just me building out my portfolio. And obviously I have not much technology exposure, and that is an area that I definitely want exposure to. But when I look at a company like CVS, we have a price target anywhere from $55 to $62, reached a little bit today at $69 a share, mainly due to the fact that I do think that this is an undervalued stock. I think it's underappreciated, and it's a stock I've talked about numerous times, so we won't go too much into detail. But I do think that the business model is very, very interesting, and I like the flywheel effect that they're taking and the flywheel approach that they're taking with their business model. When it comes to Pfizer, I believe it's sitting in my buy zone right now, right around $20 to $25 a share. Currently trading around 26, and that's about where I got in, around $26, $27. And so I did reach a little bit on Pfizer here, but when I look at where future value could be for this company, I believe it could be anywhere between $45 to $55 a share. And so that means that there's almost a 100% upside here with if they can hold on to that dividend yield of over 6.38%, and you can reinvest those dividend yields with that compounding rate of return. I do think that this is a pretty good compounder, but there is obviously risk involved here when we think about the pipeline and earnings deteriorating because of what's expiring in their pipeline. So obviously some risk with this one, but I also think it's reaching a multi-year low, which makes it possibly one of the best buying opportunities we've ever seen for Pfizer. So we basically have to go through 2013 levels to see Pfizer at these types of prices. And when we think about the cyclicality that a lot of these biopharmaceutical companies have, they get things in their pipeline, they expire off, they have to rebuild out that pipeline. But we can see here that Pfizer has had a steady higher high type of formation here and recently has sold off pretty substantial. And I do think that it'll find some support right around that $24, $25 mark. And I do think it has a compounding effect as long as it can build out that pipeline and be fiscally responsible. And I'm just not so sure about that dividend, but if they are able to keep that dividend, that's definitely a bonus overall. But I do think that they will get things right, and they've proven to kind of do that in the past, and I'm basically betting that they'll do that again. The thing I really want you guys to really start focusing in on is not what the price is on a stock, but the actual market cap of a stock. And specifically, I want you guys to focus in on enterprise value, taking into consideration the type of debt that the company is carrying, understanding that debt. And this is where I think, when we look at CVS, if there is any growth prospects here, this is where it's pretty interesting, because if we look at historical valuations on CVS, from a enterprise value standpoint, sitting at $157 billion enterprise value, which is basically in line with what we've seen. The trailing PE sitting at 11 times earnings and the forward PE sitting at 8.5 times earnings. Seems to be that valuation is pretty much in line with the company. And when we look at total revenue growth going from $268 billion of revenue to $357 billion of top line revenue, and when we bring it down to a free cash flow standpoint, we can see that the free cash flow is coming down even though revenue is going up. But there's been multiple acquisitions. They're kind of righting this ship. So I do think we'll see $12 to $13 billion once again of free cash flow, and which makes this one really, really cheap on almost every metric. An area that I'm starting to dig into here a little bit is going to be in the REITs. Realty Income being one, and then WB Carey and another one that I'm actually looking at here. Historical price-wise, we have to go back to 2012 to 2013 to kind of see these levels. Basically been trading sideways for a substantial amount of time, but I think with interest rates, if you kind of want to play interest rates coming down, I think REITs are going to be the area to kind of look at as far as interest rates coming back down, especially on the longer end of the yield curve here. Where you can get paid to essentially wait on that to play out. When I look at the REITs, they're pretty interesting here, especially if they're being managed well, and you can get 5 to 6 to maybe even 7% dividend yields, waiting for yields to kind of correct here, or maybe if you think yields are going to come down. I'm not recommending to buy or sell REITs here, guys. I'm just kind of explaining where I'm looking. I think by the end of the year, I will be looking to accumulate any sort of serious dips on some of these REITs that I think could actually hold up very well going into the next few years with the unknown aspect of real estate. Some of these companies are pretty interesting because of the way they're diversified, where even though real estate market is shifting, these companies should still do well because of how they're diversified and what kind of businesses are their tenants. And if there's definitely one thing we've learned is having a diversified tenant portfolio is extremely important when we look at a company like MPW, who is really overweight one tenant. And once that one tenant disrupted, and once that one tenant couldn't pay rent, it became a disruption for the overall business model. So making sure that there is diversification within their tenants and that they're not too overweight one tenant versus another is extremely important when we're looking at REITs in general, and making sure that the business model and the aspect of real estate that they focus in is still in high demand. But I do believe that we are getting closer and closer to a point where it makes sense to possibly add some REITs into your portfolio here. So guys, I know it's been a while since I posted, and I want to kind of come on here, go over some stocks that I'm re-entering as of late. Today I made some moves in CVS, added to my Pfizer position now as my largest position. We'll be adding more funds into the portfolio so it's not as large of a position. I basically don't want to be anything more than 10% in any specific position, unless if it's a well-diversified technology company that has extremely high margins. And in that point in time, I might go overweight between 10 to 15% on a company that I think got substantially cheap. And I'm talking about companies like Google, Apple, those types of companies. Not that I'm going to buy those anytime soon, but if they did present an opportunity, those would be the type of companies that I would be overweight, where they have multiple businesses within their model. They're not reliant on just one thing, and they get streams of revenue multiple different ways. And so those types of companies I can be a little bit more overweight on. But specifically for today, I did add some more to Pfizer. It is my largest holding, with CVS now becoming my second largest holding roughly. And then when we add in the amount of money that's sitting on the sideline earning 5%, I would say overall I'm taking a pretty substantial barbell approach here, where I have basically 50% of my portfolio getting 5%. And the other 50%, I'm kind of taking on a little bit more higher risk with companies that are trading pretty close to 52-week lows and that are really turnaround stories at this point in time. So as always, guys, this is not financial advice. This is just what I'm doing specifically. And as you can see here, this is something I'm actively managing. So if you don't have time to do this, or I just highly recommend dollar cost averaging into a broadly diversified index. Set it, forget it, and don't worry about the stresses. But as you can see, on a trade like GOLD, where we bought in at $15, sold in at $18, is kind of what brought our portfolio over the $30,000 mark. So overall, it was a really good short-term trade. And I would be looking to possibly see gold kind of dip back here and maybe get back into a gold miner once again. But for right now, I felt like it was a substantial move. It did the majority of the catching up that I thought it would do. I do think there's more legs in this, but I also think it needs to cool down. So that therefore I did sell and put it in the T-bill, earning 5% at this point in time. So as always, guys, really appreciate your time. Thanks so much for spending it with me, and we will see you in the next one.